Long term, our guest today, Marc Faber, editor of the Gloom, Doom, and Boom report, thinks we're going to hell in a handbasket, literally. But in the interim, right now, you think you're still bullish here. You're talking about you want to be buying stocks on dips here. How do you explain it? It seems that that's a juxtaposition there.
Yes, I mean, my view is like this. We have an inverse correlation. Stocks go up, the dollar goes down, because if you look at the last, say, 10 years, 2002 to 2008, stocks went up and the dollar was down. But in 2008, the dollar strengthens and everything collapses. So when the dollar is strong, it means global liquidity is tightening, and when the dollar is weak, it means that liquidity is flowing back into the system, and then stocks can go up. Now we have a particular situation in the US whereby interest rates are at zero, and the Fed has made statements whereby they will not increase interest rates much. They will keep them below the rate of inflation. And in this environment, the worst investment is, of course, to be in cash in the long run, and B, even worse, in US government bonds. So what you want to do is to be in assets, whether it's real estate or in commodities or in equities. And ideally, you're, of course, in foreign currencies or in a currency that cannot be increased in its supply, like gold, silver, platinum, palladium, and so forth. Now, the US stock market fell out of bed and bottomed out on March 6, 2009, when it was at the most oversold level after the crash of 87. After the crash in 87, we also had a very oversold position. Now we've rebounded. We're over 1,000 on the S&P from 666. So the market is no longer oversold. But you understand, it's very difficult to say stocks are overvalued when cash deposits are giving you a 0% return and when the dollar depreciates. So my view is probably for the next 2-3 years, you're better off by being in equities. I think overseas, they are better values than in the United States. But even in the US, you look at, say, Pfizer or Johnson & Johnson, these stocks are not terribly expensive.
So let me give you two possible analyses.
Yes.
One is Japan.
Yes.
Horrible, no interest on the cash forever,
Yes.
and yet the stock market's a fifth of where it was in 1989.
Correct.
So you did terribly in stocks there relative to cash, even though you had horrible interest rates.
Yes.
Then the other is the 1970s, where
Yes.
we had this massive inflation and stocks were terrible for the decade. So why is it different here?
Well, the 2 points that are important here. First of all, in the 70s, by and large, stocks did badly, but there were big fluctuations every year, so there was a lot of volatility. And also, from the lows in 74, if you bought at the lows in 74, you actually made money. Number two, there were two sectors of the markets that were very strong. Energy, anything to do with energy, and mining. These two were very, very strong. And I think at the present time, actually, gold mining shares, the exploration companies, are quite inexpensive. And I would even say oil companies, the big oil companies, are not terribly expensive, or natural gas companies. So that is a sector I would essentially look at. Number two.
I'm sorry, any specific names in those groups that you like here?
Well, I mean, I would say in the gold mining sector, you can buy the established companies, the Newmont Minings of this world, or the FreeportMcMorans. The more exciting part are the exploration companies, but they have also higher risk. But for instance, Nova Gold was at $20 2 years ago. It went down to about $1. Now it's around $4, $5. I mean, the value of the company could easily be $15, $20. They had a bid on the table for $15 or $17 18 months ago as a takeover. So there are lots of companies that are still attractive, and in the natural gas space, I would say it's a speculative investment, but Cheasepake Energy. You know, if the gas price recovers, and one day it will recover. It won't stay at this level forever. It's not easy to play it, the recovery. And then you have the oil companies, the Exxons of this world and so forth. They're not terribly expensive.
Right, okay. So
I mean, they're better probably than be in cash, because you understand, I also don't like the world. I'm ultra-bearish, as I told you. But we have to be realistic and understand in this environment, cash will become worthless. And also US government bonds. That is a bad investment. So you have to be in some assets. I would probably, if I lived in America, buy some real estate here.
You would, interesting, right. But I also want to point out your latest newsletter, you talked about that having been very bullish on emerging markets at the turn early this year, you now think the U.S. is better value generally than emerging markets? Or
no, I think actually in emerging economies, depends on the markets. I don't think that the Chinese stock market is particularly good value, and I think some other markets have moved ahead of themselves. But as an example, Russia is still very cheap, as an example. Or Thailand is not a very dynamic economy except at night, but it moves, and we have lots of companies that, in my opinion, could go up 50% in price from here. They have dividend yields of, say, 5 to 7%, and they have PEs of maybe around 8 times earnings, and they are in cyclical industries. As an example, for instance, in the US, I think as a trade, you should buy airlines. If airlines move up in the US, they'll also move up elsewhere in the world. A very depressed stock, I mean, it's already moved up, but from a very depressed level, is Thai International, Thai Airways. And I think that stock could easily double in price from here, easily.
Yahoo!